In this video, I want to share 3 tips, 3 strategies to reduce your risk in your stock portfolio. I think it will be very helpful to you if you want to invest in stocks for the long term, if you want to compound your wealth for the long term. If you are new to this YouTube channel, welcome. My name is Christophe Nour, and I've been investing in the stock market for almost a decade now with a performance of 25% per year, and I use these 3 strategies. So let me start with the first one. Let me put here how to reduce the risk here as a title. The first one here is to have some diversification. That's very simple. Don't worry, the second point and the third point will be better than this. Let me put some diversification here. I see some people on YouTube, on Twitter, that only have 3 or 4 stocks. Maybe that's okay for some people, but for most people that's a little bit too stressful and that's a bit too risky. The only reason you can have 3 or 4 stocks is if your 3 or 4 stocks are already diversified, like Amazon, that is available everywhere in all the industries, or Berkshire Hathaway, available in many other industries. That could be good reasons to own 3 or 4 stocks. And the opposite scenario is to have too many stocks, like 300 stocks. I know some people that have 300 stocks, and as a retail investor, you add a lot of transaction fees and a lot of unnecessary stocks if you have 300 stocks. So definitely something to consider. The sweet spot for diversification would be to have between 8 and 30 stocks. Having between 8 and 30 stocks is a good reminder to have your data you follow and monitor the companies. You can also have some companies in your watch list that you can monitor, but it's already hard to follow 10 companies, guys. Follow the earnings reports, follow what is happening with the companies you own. So it will be even harder to monitor 20 businesses or even 30 businesses. Personally, I have between 10 and 15 companies at the moment, and I don't plan to increase the number of stocks I own. So I don't think I will be having more than 15 stocks in my portfolio. So I'm telling you, the first point is diversification. Don't go to an extreme level. And if you want to reduce diversification, have some concentration. You want to be in different industries. Okay. Now with the diversification, let me add something else, is the rebalancing. There are many strategies to do the rebalancing. Either you don't touch your stock. So if you have a stock that doubles, triples, you let it grow, and it becomes a large part of your portfolio. It can be stressful if this stock suddenly collapses, or you can rebalance and say you don't want one stock in your portfolio to have a 20% allocation or more. So every time the weighing in your portfolio grows back to 20%, you cut it back a little bit. So that could be a good way of reallocating, rebalancing your portfolio. And if you own a diversified portfolio that you rebalance correctly, you will have a nice performance, a decent performance, and some good risk allocation, because you will know what you're doing. If you monitor a stock and you don't like the way it's going, you can reduce it a little bit. You can trim a little bit. And if you like the growth prospects of a company you already own, you can double down. That's what rebalancing is. You assess the odds of success for any week, any months of the market, basically what is happening in the market. So every month of the year you can assess, rebalance, double down on your highest convictions, or just sell a bad investment. You rebalance. I would say it's good to rebalance every 3 months. What I mean by rebalancing is either you do something or you do nothing, but you assess your situation, you assess your odds, you assess your risk reward. You see if this is a good bet, a bad bet, a good investment, a growing company, or a bad investment, because a company can be bad. So that's a good tip for you to reduce your risk as a whole. Some diversification and some good rebalancing. The second thing to reduce your risk as a whole is to invest in high quality companies with pricing power. Now we are at the beginning of 2025. We have a lot of uncertainties in the market. We don't know if the AI thing will continue and will be profitable. We don't know if inflation will continue to be high in 2025. We don't know if interest rates will continue to be high in 2025. So how do you hedge yourself against all this macro risk? You invest in high quality businesses that will do fine regardless of the environment. Take the example of Hermes, our French luxury name. They sell bags and scarves, and they sell luxury regardless of the environment. If there is inflation of 5 or 10%, it's okay. Hermes will increase their prices by 10% and people will continue to buy their expensive bags. If we have high interest rates, low interest rates, okay, they don't have a lot of debt, they can survive. If we have a recession for some reason, it's okay, their culture remains. So when I say invest in high quality companies, I also want to say invest in companies with a good track record. A company that has been there for many years, if not decades. For example, you have Google that has been operating the same way for years and years. Meta, you could say, has been operating the same way. They have been through many crises. They know how to deal with harsh situation, and you have a good vision, a good culture for these businesses. So the second point is to invest in high quality businesses. And let me add another thing. Let me double down on pricing power here. Now we have a very high chance of having high inflation in the future. We don't know what will be the percentage, but it's unlikely that inflation will fade away. Inflation will be here 3, 4, 5%. So over the coming years, you want to be invested in businesses with pricing power. Companies that can increase their prices for the long term, and you will see no churn. Hermes is an example. Apple with their iPhones is an example. So you want to avoid companies without pricing power, basically. You want to avoid companies with a lot of costs, with very thin margins, with high impact by the raw material prices, by commodities. You want to avoid cyclical businesses. These are two complex situations. So a second strategy to reduce your risk would be to avoid companies without pricing power and only focus on companies with good pricing power, a long track record of being efficient, profitable, with a nice vision in the future. You want strong financials, strong growth in revenue, earnings. Even in 2008, you can check if they were profitable in the past. You want to see the track record in the past. You want to see what happened for the company. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. And the third strategy to reduce your risk for your global stock portfolio is to only focus on companies with a high quality management. Speaking about track record, you want to check how the company reacted during tough times. You want to see how the management reacted in times of crisis. The past crises we had were 2022, kind of a crisis. 2020, complete crisis. 2008, crisis. So you have 3 difficult moments for everybody. And now you have other crises for specific businesses, for Meta platforms in 2021, 2022, and their shift of identity, or Netflix in the same situation, or other companies and other times. Check how the management reacted in bad times. Check if they did the right thing. One right thing could be to focus on what really matters for the business, have key KPIs. Like for Meta platforms, Mark Zuckerberg, he's only 40 years old, but he has a lot of experience and he has been navigating through the crises really well. Many crises, TikTok, Snapchat, Apple taking some market and Apple Store share, VR, Apple and their cookies, ATT procedure. You had a lot of problems for Facebook and they survived really well and rebounded really well. Same thing for Netflix. You had some crises. Just spend some time studying how management reacted. If you can read some books, biographies about the CEOs, that's even better. And one thing that could be interesting for you is to check the valuation of these businesses over time. Let me put something else here. Imagine you have a PE ratio of a company over time. This is your PE ratio, okay? Then you have a crisis and then goes back up, crisis. Imagine this is your PE ratio, right? You want to check if a company has done smart buybacks. Buybacks meaning you repurchase your own shares, you invest in yourself. A good way to create value for shareholders is to buy back your own shares when the company is cheap, when the company is undervalued. So now it can be I'm not putting figures, it depends for every company. Imagine now that the company was undervalued here, and then the company was still undervalued here, and then the company was still undervalued here. How did management react when the company was undervalued? Did they do buybacks? You can check. You can check. You have free tools, paid tools, websites on the internet to check the valuation, the PE ratio, and the buyback program. Did the management increase the buybacks at these 3 occasions, as these 3 times? If they did, good news. They know how to allocate capital, reward shareholders, take advantage of the volatility. That's nice. If the management did nothing, you will have other questions for the business. But a good way to see if you have a good management, high quality management, is also this. You want to invest in companies that care about the shareholders, that care about you, the shareholder. So if you have a good company, strong efficiency, strong management, good vision, pricing power, and if additionally they do smart buybacks when the company is trading cheap, you reduce your risk. So these 3 strategies can be implemented really fast. And this is really simple stuff. You can take advantage of the volatility. And if you invest in these 3 categories of investment, like some good diversification of portfolio, high quality businesses, high quality management, good buyback, etc., you can outperform the market. You have a very good portfolio with very minimal risk because these companies will do well in any market. Inflation, no inflation, high interest rates, low interest rates, recession, booming economy, high employment, low employment, everything, everywhere, anytime. And I believe that if you have a diversified portfolio filled with these great companies, you can do really well in the market. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.